I own international funds in my bucket 3 growth portfolio. I need some help today. Just a little bit unusual video. I've been stirring on this topic, studying, asking people's opinion for a long time. I currently own 17% international funds inside of my bucket 3. Bucket 3 is my growth portfolio. I think most of you know that. It's all growth, money, investments I'm not planning on selling for at least 10 years. 17%, the balance is in the US. What say you? Okay, so I'm going to put together some background on that. I'm going to show you that in a PowerPoint presentation, which I really don't like to do this, but I will because I think it's the best way to share some background here. So I'm sharing my screen. You should be able to see my screen over here. Should I own international stocks? Okay, I'm going to show a chart here in a second, but it's the MSCI, which is the Morgan Stanley Capital International USA Index, to the world index. So it's going to be a ratio of the USA to the world index. And the MSCI index, is the large cap and mid cap stocks in the US compared to the world, this is just the developed world, okay? Just a developed world. I like the way this chart looked. That's why I'm showing it. If the ratio of the two, it's got the USA on the numerator and the world on the denominator. If the ratio is going up, that means the United States stock market is going up comparatively to the rest of the world. If it's going down, the US stocks are underperforming against the global market. Okay, I'll explain that again, but I want to get that out of the way first. So here we are going back to 1971, all the way up to, this is December of 2024, okay? What I want to draw your attention to is this red line here this is a ratio of 1. Okay, so that means exact equivalency of the USA, which is in the numerator, to the world market. So if it's right on the line, they're balanced. Okay, going back here to 71, look, this downward slope means internationals were performing better. So the international capitalized market was getting bigger as this is going down. Okay, again in 76, we had it down and then a flat. And then in mid 80s, it was kind of flat and then another down. Okay, now here's the first real upswing. Okay, this means US capital markets doing better, large cap, mid cap. Then we got international doing better. And we got USA doing better, flat for a long time. Then we got the great this is the .com right around here, drop down. And then you had the great financial crisis here, 2008-9. And then since then, the United States has just been on a tear, okay? Now, what I want to highlight here is look at this period of 14 years here, 15 years, 14 years, I guess. It's just been a straight line. Compare that to history. We've had a lot of periods of time, 1, 2, 3, 4, 5 periods in the last 50 years where internationals were performing better. And then we had a lot of flat spots here where they're performing about the same. This last period, 14 years looks unusual compared to the last 40. So should we expect this to continue climbing and run away? Or do we expect a reversion back to normal? That's the question, okay? Okay, why is the US doing better? I'm going to link an article where I got this from, and it's a Morningstar document that analyzing 2010 to 2022. That was the best article that I found. It said basically the US during that time period, 2010 to 2022, is up 12% annualized, 12% a year versus global ex-US of 4.4, and just the developed nations, global ex-US 4.6. So, I mean, that's not even close. That's a massacre. Okay. Couple reasons why they, stated that thought this article writer thought U.S. was doing better. Structural advantages. The United States has a great university system, attracting some top talent and some top talent innovation. Deep capital markets plus scale advantages. The home team here is pretty big capital market. So just set up from the get-go to be in good shape. Number two, more exposure to technology and communication services versus the old economy of like financial services, material and industrials that tend to dominate the old economy developed markets. Number three, runaway of the Magnificent Seven. Those Magnificent Seven. They're there if you need to know what those are. Bottom line, the U.S. has just had superior fundamentals during the last, 14 years. 6% annualized earnings growth versus nearly flat earnings growth for ex-U.S. So that's the why. Okay. Now, what's the case for international? Price. Let's show you a chart here on price and mean reversion. Mean reversion is a characteristic of the S&P 500, mean reversion. So what is that? So I'm going to show you. Here's the S&P 500 ratio. I'm sure you've seen this before, a chart like this. This goes back to, I went back pretty far here. I didn't realize that 1875. I guess I should have looked at this closer. And it goes up to December 2024. You could see out here the PE ratio of the S&P 500 is just under 30. Now, we've had some other spikes. This was during COVID where we had, no earnings. And, if you have the same price and very low earnings, you get a spike. So ignore that one. This was the great financial crisis, I'm assuming, and then the dot-com crisis in here. So each one of these were bad news, and we're kind of heading that direction here. But if you look at, let's talk about mean reversion first. Here's the mean of PE ratios. Somewhere around 15 is mean reversion. Look at where we've been for, since 1875 up until, the mid 1990s. It's been hovering around this yellow zone, and we're well out of it. So how much higher will we go? When will the mean reversion happen? Or will it happen? Are we in a new reality? You got to answer that. And I'm asking for help. Now, I don't have it. I chose not to put a chart in here on international because every nation is different. But I've seen some countries at 9, 10, 11, 12, 15. So they're in the low teens as a PE ratio international versus 30. So you're about 2x. And, there's a direct correlation to, future returns. You've heard these studies. I don't have any to quote here, but I don't think it's a rule of thumb. I think it's just history is, high PE ratios. When you look at forward returns, they tend to be lower. So all the data seems to be pointing towards a mean reversion, and international stocks are on sale. Okay. So, but I do go back to the reasons, that's mean reversion. You still got structural advantages here in the United States. You still got more exposure to technology and communication. You got the Magnificent Seven, making good products, making good profit, and superior fundamentals. What do you think? What do you think? I'm currently at 17% of my bucket 3. In the comments, let me know how much international exposure you have in your long-term growth funds. If you don't have buckets, just your equities. What percent are you inside of your equities international? And let me know that percent, and then start a discussion on why. This is one of the issues that's been bothering me that I wanted to get input from this group. So far, I've made the decision to be at 17%. And if I go back to reasons why, you look in this period right here. I started working here in the late 80s, and the U.S. was doing really well, but there was a period here that international did really well, and the international did really well during the lost decade, that 2000 period to 2000, like not 8, 9. The international funds did really well and helped my portfolio significantly. I believe during that 2000 to 2000 time period, my portfolio beat the S&P 500 by 3.5% compounded annual growth rate. So they've done really well for me in this period, but the last 14 years has been a long time. So give me your percent and let me know why. It's Joe out.